So, hello everybody. Thank you very much for finding time to join us today in a masterclass which is dedicated to finding and maintaining optimal terms of trade credit. In terms of timing, we will be on air for about an hour, maybe in 40 minutes, depending on how will we work. Then I will be happy to answer any questions you have regarding, which are belonging to credit management and everything related to that. You can interrupt me, you can type your questions over today's session in the chat, and if I am able, if it is appropriate, I will be answering them immediately. Otherwise, as I already mentioned, we will have a Q&A session to discuss everything. In that section, you would be able to unmute yourself, use your video, and we can have really a discussion. If you have questions in the beginning, please ask them right now. Otherwise, let's follow our program. Well, first of all, we need to dedicate a couple of minutes for kind of introduction. What I find over my career and over my career in corporate credit management and over my career as a consultant is that companies and managers do not dedicate, I would say, sufficient time, sufficient efforts, and sufficient intellectual capacity to this specific area, which is terms. And then many of them become surprised with the results they have, with overdue, with bad debts, with number of sales orders which have to be released and so on, and this becomes really a workload. And all this time, all these efforts, all these budgets in the end could be significantly reduced. And in parallel to that, I have to say that also relationship with with sales department, with marketing department, and with customers could go much more smoother than if we just try to insist on terms which are inappropriate and try to collect cash and try to just control everything we need to control instead of adapting. I would like to start our today's session with a bit of ideology. So when we look at credit management, first of all, we need to remember that credit management itself is not living on the island, and it is not a separate business. Credit function, whether or not it is represented by personnel dedicated to credit management, or it is just a function exercised by normal or just usual, not specific business personnel, it remains credit function, but it has its own expectations from the business. And these expectations are generally four. So let me start my presentation and we continue. If you don't mind, I will stop my video just to make sure our other pictures are working okay. It is quite simple. There are four main expectations of the business from its credit function. First of all, we need to remember, and we would not be discussing that quite deep, but First of all, we need to remember that receivables and trade credit exist to get competitive advantage. It is this is its main purpose. Therefore, no business wants to lose sales because we've got credit function. I don't say here, because sometimes this becomes disputable, that like lost sales is not like we need to we need to accept every sale. No, this is not correct. We are speaking about profitable sale, but too often companies lose sales because of too low credit procedure, too low consideration, lose volume because sales orders are considered for too long, and so on and so forth. These are everything sales lost by due to credit purposes. Then obviously every business wants to have something close to zero overdue, and every business doesn't want to write off any bad debts, and obviously no business wants to have all these results at high cost. So expenditure should also be at the controlled level. And the guy in the center with the briefcase is really a workhopper, in these 4 dimensions, who is trying to balance this everything. However, achievement of these, or results of this, or close to this, look much more simpler if we try to define how this could be achieved. And surprisingly, I found such a definition. Okay, we may call it strategy of credit or ideology, which mainly mean that we need to create conditions where the majority of customers buy product, pay on time, and order again. That's technically everything we want. And this is everything which business want. And the one may ask, where's credit management here? There is no place here for credit management. Credit management is technically outside. Credit management is a function which is called to organize this everything and make sure it works smoothly. My favorite, I don't say comparison or metaphor of even fairy tale, but I like very much a story about the reparation teams of Henry Ford. In this production capacity with all these conveyors, there is always workers who do reparations to the equipment. According to the story, these people were paid hour rate for the time they spent in the lounge, in the room where they just taking rest. So each time they have to leave this room to repair the equipment, they don't get their payment. So this means that as long as everything goes all right, everything works smoothly, they receive their payment, and they are motivated to make sure that everything is going smoothly. Somehow, credit management, to my understanding, is to look more or less like this. So customers don't need involvement of credit management. Unless there is an issue, obviously. Customers don't need, and business itself don't need, these great achievement, everything. They just need that, goods are shipped, paid on time, and order again. And this everything, this cycle spins, generating profits and cash flow on both sides. Saying that maybe a bit earlier, I would say that each time I am asked what are the optimal credit terms, how do they look like, I answer that question in one word: they look silent. The customer setup, customer terms must be silent. So it just they like famous one of the very first slogans of company Apple was like, it just works. So credit terms or terms of trade credit should just work. And to be so, or to deliver that, these credit terms must be what is called adequate. Some people use the word balance. Sometimes people use like appropriate. I like the word adequate. So they're adequate to our business. So we are not taking too much risk. They're balanced from and profitable for us. They are adequate from customers' point of view, and they are adequate to the market situation. And today I will simply share with you, I would say, approaches how to find and what can we do to maintain them in practice. Because we all understand, I believe that we all understand that neither terms, whatever perfect they are, could remain so endlessly. The situation changes on customer side, the situation changes on our side, the situation might change on the market. Therefore, we need to adapt our terms to make sure they remain adequate and they remain optimal to the business. Well, first of all, we need to, and I would like to highlight that this, my observations I've seen from the companies, quite interesting that, vast majority, if you look at the horizontal axis, that vast majority of companies put the most part of their efforts in collection and control, which generate about half of result. Another half of result is dependent on terms. Sometimes I get criticized that, just for saying that collection is not important. I never say collection is not important, but what I'm trying to say is that the whole credit management could be called preventive collection. So we just need to organize our work and work with customers in a way where the collection would not be necessary at all. Just like removing obstacles from the way of cash to our bank account. And significant part, I would say good half, because I don't have that firm statistical background or any statistics which say in the terms which would be like firmly proved, but from everything I've seen, from my observations, 50% of results we discussed above are coming from the terms, how we build terms. By contrast to that, if we simply take credit limit just because we think the one we think is correct, if they take a credit term which is again whatever credit term it is, and so on and so forth, then we receive final results which are like, either sporadical or those we don't expect. So the more efforts we take to define optimal terms, the better results we have in the end, and the easier we get them. So let's stop theory and ideology and get back to the point. Usually credit function takes three main decisions, and two of them we will be discussed today. First of all, what terms to offer to a counterpart and what to do if aligned terms don't work. The third one, how to get money back, is already belong not to terms but to the collection. First question, let's look at it practically. Company has a new practical task, or more or less what happened in the many companies, especially in trade credit. Company has a new customer. They're ready to purchase about 1,000 units at price of 90 and 45 days credit term request from management. May we grant credit to this customer and on what terms? May I ask you to type in the chat if this in general, more or less, how the credit, how the first question or how the first task is defined. Or maybe you have differently. Just like here is a customer, we plan to sell to them this amount of volume, or there will be a turnover, and then credit term is like this, or expected credit term is like this, and can we grant them credit? Does it seem appropriate from your side? Okay, it's more or less unclear, the silence. May somebody just... Risk assessment need to be done first before determining terms and limit. That's exactly, but why we define that? Because we are planning to sell. Obviously, we need to do risk assessment, otherwise how can we define it? But surprising thing, even if we are unable to do risk assessment, we have to take a decision. We might have luxury to be on what is called exclusive credit situation, where we can choose customers, but too often we simply have, too many companies have to ship goods to their customers, and I could not say despite credit risk, by taking credit risk. Okay, let me take your silence as sign of agreement. More or less the same situation is happening in majority of companies. So that's the way it is coming to the credit department. Maybe there is other advice. Mohammed, I completely agree with you. Credit risk is to be identified, but do we identify credit risk for somebody we don't need to work? And why we identify credit risk? Why we do that? Because we are planning to sell to the customer. Do we identify credit risk for companies we don't work, or we do not plan to sell? Do you agree with me?
Yeah.
Thank you. So the initiation of that job, I don't disregard assessment of credit risk. First of all, risk identification. We know we're supposed to take or do not take credit risk. I'm following the logic nicely stated by Mohammed. However, then when we speak about credit control implementation, why shouldn't we ship goods first?
Never.
No, after setting limit, after everything, we need to define credit terms. We need to put them into the contract. Then we ship goods, and then we control, and then we monitor. Because otherwise, why do we have all this credit management if we don't sell? And on other side, as I said, there are two big parts of credit, two big worlds of credit. In some cases, we are very competitive and customers are queuing to purchase our goods. In that case, we are choosing customers by their creditworthiness and other components. But vast majority has to compete. And we need to provide credit just to remain competitive, and we have to take risk. Because there is also other risk. We are risk of losing customers. And this is different story. And this is different story. And here we need to remain competitive. We have to be, we have to compete. And I would say risk taking from nice to have becomes everyday necessity. Obviously, very good if we have an alternative, but what if not? Just like with cash in advance, we can cut the branch we are sitting on and simply ask all the customers for cash in advance. Would it be good for business? In some cases, yes. In some cases, not. So the credit management exists. I mean, depending on the situation, we can choose one route or the other. But in very general term, credit management exists to support sales, which is extremely important. Because if we don't support sales, we are not doing our job properly. Because credit management exists to sell receivables. The only reason for receivables to exist is to sell. Therefore, our job is initiated by the sale. So we got a customer, and then we need to ask what terms we can work with this customer. As a matter of joke, I will show you. So that's the situation I have happened to me in my life. So there was a facility of 100,000, then there was 5% of default probability. And then how can we take decision what credit limit we can give? That's the biggest problem when we try directly, let's say, banking loan methodology to trade credit and try to take a decision. Then, okay, how can we decide whether or not we can grant credit of 100,000, whatever currency it is, to a customer with default probability of 5%? We need to compare comparable. So just default probability and yeah, we got comment. Well, we can take it from, let's take it from, I don't know, Altman formula, or from credit rating, or whatever. Imagine we have a credit rating. Mehdi, may I just ask, let's assume we are the company. So obviously we can't define the credit policy, everything, but in the end of the day, we need to take a decision. And what can we say, for instance, to, I don't know, private entrepreneur? We as credit manager, could we say to a private entrepreneur who is deciding whether or not they can ship goods to ABCD company? We need to build, we need to take a decision. This is, everything you say is correct, but in the end of the day, we need to decide whether or not we can give this or that customer, we can trust this or that customer certain amount of money or economic equivalent. Obviously, if we have obviously we can have advice from other parties. For instance, we can have a credit limit from I don't know, from the credit report or whoever, but again, it is not reflected as a default probability. There is a credit limit recommendation. By the way, if you wish to have a bit of fun in terms of credit management, ask providers where do they get this credit limit from. Tracy, we would need to discuss escrow account because this is quite interesting topic, but I think it will take too much time. This will be difficult for me to follow our today's structure. Thank you. There are threshold limits approved in 24 hours provisionally for a maximum of 1 to deliver it, but most companies take the final decision in 48 hours. But do they do that based on default probability? You know, the problem with default probability is quite simple. It has, I can give you quite simple example. You see that you know, small company and you know, concern like Apple could have, or I mean, in size of, you know, $5 billion company in terms of turnover, and $100,000 company would have the same default probability. How does it answer the question how much money we can trust them? Default probability could help us to answer how much money we can trust, but the problem is we cannot use default probability directly to the facility sought. We need to reflect it in terms of creditworthiness, reflected in the amount of money we can trust to a customer without any additional security. This part is already explained in one of the previous master classes, which I will share with you by the link after today's session, which is called creditworthiness, or definition of creditworthiness. I will share with you because today we won't be discussing this. Today our idea is to structure and find optimal credit terms. So the idea is quite simple. We need to reflect creditworthiness of our counterpart in money. In that case, we got a chance to compare apples and apples. So we need to compare creditworthiness and what is called credit demand. Both components already covered by our master classes. You will have link to both. So we need to compare two things. How much money we can safely trust to a counterpart, and then how much money it is needed to trust to a counterpart to achieve the objective of our transaction. These are, I mean, if you ask financial people, they will say that creditworthiness is the credit limit. And then if you ask salespeople, or if you ask business development at everybody, they will say, okay, credit demand, because we need to calculate how much sales we would like to achieve, then how much credit is needed, and this should be credit limit. In the end, the only correct answer is the credit limit is the amount of money we decided to give to our customer, how much money we decided to trust, how much risk we decided to take or we decided not to take, and so on and so forth. But the key idea is that this is our free will of a creditor. It was quite interesting. Once I started a poll and asked people to give comments, and no one, including lawyers, tell me that there is a law which insists that the creditor should provide credit to a debtor or to a customer, to everything. So, long story short, credit or credit granted is always a free will of a creditor. So we decide how much credit we would provide to our customer. And this is, by the way, why our receivables and our credit portfolio and performance of every our customer depends on the decisions we take, first of all, and then on what happens to the customer. We obviously, in order to define credit demand, we need to know what is the credit term. Credit term, again, you will see that in practical example. We need to define what credit term is, and very often in companies we have quite casual approach to the credit term. So companies usually, significant number of companies simply grant a credit term requested by customer. Some companies are asking for the credit term, consider maybe 2 or 3 factors. I would say about 6 or 5 shown here supposed to be included into understanding. This is legislation, this is operating cycle. We know that there is profit and interest relationship, and how long credit we can grant to a customer in order to remain in order to remain profitable. Obviously, product life cycle, and most important thing, competition. So we need to have a look what credit terms are given by competitors in order to provide customer because credit term is actually commercial matter. We may speak about the DSO, we may speak about better DSO, we may speak about whatever credit term we would like to grant to our customers, but customers are in commercial reality. If similar products or competitive product or a substitute is traded on the credit terms between 30 and 50 days, we need to have something really attractive. We need to provide a quite expensive incentive to our customer to work on us with the shorter credit terms. Or we need to be so competitive so they are ready to purchase our goods or our products on any credit terms from us. In this case, I always suggest if we can sell on cash in advance, we should do that. Approaches to definition optimal credit term. Again, this will be the third masterclass, which we already did. This was already discussed, and I will share with you this. I hope you will enjoy it, and if you have questions, please don't hesitate to come back to me. So today our idea is how to get all these components together. This is main idea of today's, and structure the credit deal and make sure it works. So we need to define credit term, we need to define credit limit, and we need to define credit demand. Obviously, knowing credit term, knowing potential credit term, or what we called range of optimal credit terms. In this specific example, from 30 to 50, we need to take sales volume multiplied by price, get future turnover, then multiply by term, divide by 365. If it is for year or by month or whatever, we need to adopt this formula, or we can do it using continuous balance, and we can define the credit demand, which give us an example how much credit is needed to sell, and then how much credit we are able to give. Here is the example how we can use it, knowing the future sales and the current credit limit. We've got question. I will send this all the records, including the previous master classes, dedicated to. So there the question is, where can we find this record later? You will receive it. You will receive a link to our YouTube channel with all the links, including today's session. So we can define how much credit is needed, then we can see how much credit we already give, or we can do it in a bit more complicated way. So we know that how much credit we need to give to a customer in order to ensure we achieve our sales volume. And we can take creditworthiness and see how much money we conditionally have to put under the risk. And if we already trading with this customer, we can put here the credit limit and see, for instance, when our credit limit will become insufficient. It looks much more complicated than it is in practice when you got kind of skill or habit, and it works pretty well because especially when you share this information with your sales colleagues, it works pretty well because when creditworthiness and default probability does not ring any bell in the heads of our sales colleagues and others, but when the creditworthiness is reflected in terms of money, language of money is clear to everyone. Trust me. And it is clear to marketing, it is clear to general management, to HR, to everyone. So when we say that customer is creditworthy for 100,000 and we need to give them 210, this means that we need to put certain amount under the risk, and this becomes much more clear and much more, I would say, sensitive than default probability. And this turns our sales colleagues and management to our side, and we can say, okay, now let's take a decision whether or not we can take risk or we don't take risk, or do we take such a risk in this amount or lower. So from virtual matter, which is like, okay, customer will either pay or will not pay, this risk become somehow material, somehow visible, and somehow clear because it is reflected in money. I don't say this is perfect methodology, but this brings understanding to every involved party. And then, so technically what we do, we compare creditworthiness with credit demand, and that what we do with what can we do. Then we decide what can we do with the difference, and it is quite simple because there are 5 ways to manage risk. We can avoid risk, we can accept risk and obviously get full opportunity. We can hedge risk, which in case of trade credit we can create kind of bad debts provision or potential credit losses. We can transfer risk to a third party at an additional cost, and we can mitigate. Personally, I don't believe in mitigation in terms of credit risk, like all these reservation of title and everything. It works very well until customers pays on time. When customer stops paying on time, all these instruments, become just like something which we felt ourselves comfortable with before customer starts delaying payments. So technically we've got 3 main options. So we can put credit limit on the level of creditworthiness, and this will be risk avoidance, depending on what is more important for us: avoid credit risk or to achieve our sales target or our objective, our goal. We can put credit limit higher on the level of credit demand and obviously get full opportunity ourselves by taking risk. In this option, it works pretty well. We may immediately, knowing that we are taking high credit risk, we can obviously use hedging here, and we can create immediately, with new accounting standards, we can create additional bad debts provision and therefore hedge our credit risk with that. And obviously we can use what is called credit security and trade finance tools, which somehow is increasing customers' creditworthiness, but at the cost. This cost could be ours. So if we can pay for this security, like in case of credit insurance or letter of credit partially, or we can ask them to provide the bank guarantee or other type of acceptable security, and then either customer will pay for it or we may pay for it ourselves, or we can split the cost. Anyway, we will have more profits if we sell more to the customer, providing more credit. Therefore, we can take part of these profits and use them to compensate customer for the provision of trade finance or credit security. So it will be mutually beneficial for everyone to use this instrument. In terms of structuring, again, this might look quite complicated, but all the elements you see here already. And we can just see that there is potential outstanding for two different credit terms, for one and for second one. So we got credit limit, we see what is the credit worthiness, we got credit security, and then we got potential sales. Obviously, if we got shorter credit term, we might have shorter sales, and we need to take care of our profit. So we just need to have holistic view, and obviously all this data taken together and presented to our colleagues, for instance, to sales and together with management, really facilitate the optimal credit decision. So how can we go, what terms we will offer to customer, what terms we will agree, and then how can we work and maintain? How can we work and how can we maintain them? Because we understand that sooner or later we would need to review them. And when we will have to review, we would need to take all this data together and see what has been changed. Any questions about what has been said? Because we are moving to the practical example. As I said, it is not that, in practice, it is not as complicated as I say in theory, because it might be too ambiguous, too vague, too unclear. But when it comes down to practice, obviously you need to have a look at how to define credit demand. It has some specific features. Then you need to look at how to define optimal credit term and how to get to the credit limit. I mean, actually to assess credit worthiness. And then we get in everything together and keep this structure to define the credit limit, the credit term, and the credit demand. So let me show how it looks in practice. So from credit worthiness, it's quite nicely explained. It was quite nicely explained before. We do basic check of a company. We find this company is not a fraudster. Then we take country risk if it is export transaction, and we take customer financials, have a look at them, and using whatever model we have or whatever model we use, we define their credit worthiness. Obviously here we got very important thing, which my favorite joke is that good credit analyst is not calculating, good credit analyst is writing. So it's judgment, it's an opinion of a credit analyst who says that this company is credit worthy to this amount or lower amount, because this is like judgment of professional analysts to adapt the results of credit risk model. So model is calculating, then the credit analyst is to conclude as objective as possible to define this simple amount. So how much money we can or could be trusted safely to this or that counterpart. Then, knowing it, we understand that knowing this safe amount, it could be lower or smaller, we need to define how much credit is to be given to the customer. So for that, we need to take legislation cycle. We need to compare what is the profitability and what is our financing rate to define how much credit we generally can give to a customer. And then we combine all this data into the matrix. By the way, together with masterclass about the optimal credit term, there is an Excel tool which you can use for that. It is for free, but you are not allowed to sell it. So we define the range of optimal credit terms here with a specific example. This is from 30 to 50 days. So knowing it, we know that our credit term should not be, we should not count to get credit term shorter than 50 days. And shorter than 30 days, but everything over 50 days will be already too much, so customer will be abusing our credit facility, which we would like to avoid. If it is extremely important, we can do that, but we need to understand why we go that far. And we put this everything together in a quite simple table where we know our volume, we know price, so we can calculate future sales. This is our sales forecast. Here it is flat, but in practice it could go up and down. And we know that there will be credit demand there. So the amount which shows us how much credit would be required to achieve this level of sales. And then, obviously, as additional information, because we understand how much exposure we would have with this or that level of credit demand. So relationship between creditworthiness and the credit demand, this will be a conditional number which is telling us how much risk we will need to take with this customer, and we better compare it with the gross margin or net profit or whatever other benefits we could have. Plus to that, we can see how much of that gross margin or profitability we will earn over the 6 months. Again, number could be the length of the period in subject could be longer or shorter depending on your business, depending on your industry. And then we decide what are the potential scenarios or potential terms we can offer to a customer. Obviously, customer will be requesting for longer credit term, or maybe their requirement will be 45 days credit term. In that case, we would need to add here additional scenario with 45 days credit term. And we may decide which credit limit we will give to a customer. Maybe we will request for security. In this case, in this specific example, what we did, we simply stood with 45 days credit term because it was quite common on the market, and then we simply shown customer these numbers in terms of creditworthiness and said, okay, would you mind to provide us with a bank guarantee covering the outstanding amount, so everything which is above your creditworthiness. And let us, because customer was very good and we were working with them for quite a long time, they say, okay, but this is cost. We negotiated that we will split cost 50-50, so customer was extremely happy. They earned money, and I have to say that I think in couple of years, because we are reviewing this model, but then they seen that, okay, this requirement for the bank guarantee was hardly dependent on their creditworthiness. They changed their dividend policy, so they reinvested much more money than more money than they used to reinvest into their business. So they did a capital injection, so they became more credit worthy. So after 2 years, we started to work with them without any security, without bank guarantee. and the customer was extremely profitable. Let me just come back. So if you have any questions about the setup, there is no ideal, just to finalize, there is no, let's say, ideal position or ideal term, but we are as closer to that ideal situation when we got clear and common understanding between sales, credit, and the customer. If everything is clear in terms of credit setup, customer understands when to pay, why they have to pay, why the credit limit is so, and what is needed to change it. This becomes much more smoother in terms of psychology. In terms of credit worthiness, I have to say that one thing is to know credit worthiness of a customer. We would be being able or be good credit analyst, and it is absolutely different, but significantly more important thing is to understand the business of the customer. So we need to understand the needs of our customer and then do that setup. So this could be quite specific, because sometimes needs of our customer are much more easier to satisfy than we think. So with regards to, let's say, ways to define optimal credit terms for a new customer, this is everything. Do you have any questions about this? Because we still need to cover what to do about resetup and review and maintaining optimal credit terms. Okay, maybe it's not completely clear, so you need to think. Let's keep it for the Q&A session. So we know that, as I said in the very beginning of today's session, that neither setup, neither terms could be optimal forever. We know that situation is changing, and technically two parameters are usually changing. These are credit demand and credit worthiness. So what we could have different situations. For instance, credit demand could change, and in good situation for the business of a company, this credit demand will grow up. This would mean that our credit limit supposed to become insufficient, as it is drawn on this picture. I mean, if you look at this 1, 2, 3, 4, 8 months, 8 coming months, the situation, or let's say forecast of receivables, we see that already on the second month, which is here, we will have our credit limit insufficient to cover needs of a business. We will see this all nice everything situations we can speak with about the insufficient credit limit, and this is not like our customer is abuser of our credit facility. They simply need more our product, so we have more sales and we expect to have more profits. However, we might not have them if we don't react properly or if we don't react on time. Therefore, if we recalculate or do an update of credit demand on regular basis, we can foresee such a situation, and again sit together with our sales, with our management, and say, okay, credit demand is higher, our credit limit is like this, but to provide customer with additional credit will cost us additional risk taking. So what can we do? You see, this decision could be different depending on how it is taken. If we start to think about this when the truck is on our warehouse, or when ship arrived to the vessel arrived to the port, and we have to load it, but then it becomes clear that we don't have credit limit. This is one situation. It is much more difficult situation because we all are in rush. We all tend to to blame everybody else who is guilty in our problems, and so on and so forth. But when we do that in advance, we still have time to speak and to find solution with the customer. But when we see that, for instance, in the situation drawn here, we understand that credit limit is insufficient. This means that in 1 month or in 2 months time, or whatever time is, our credit terms will become inadequate from customer point of view and from our business point of view, and by the way, from the market point of view as well somehow. So we need to review them. The same story could be if, for instance, we know that over this 6 months, or if we put years here, let's take kind of example of industrial goods, credit worthiness could deteriorate. And then this will be the same situation. So we know that the credit worthiness has been deteriorated, so it went down, it became lower, and we were granting credit to a customer assuming certain level of credit worthiness, but now it is lower, which would mean that, which technically means that we are taking more risk. And then what should we do about it? What will we do about it? Will we provide customer with the same credit, or we try to negotiate different terms, or maybe we can be happy with the risk we take? This could be the case as well. But we already know that. The biggest problem with the monitoring, by the way, is quite simple. Substantial number of companies really assess customer when they start working with them, and then they forget, and then they rely on this credit worthiness assessed 5 years ago, and they still think that their customer is credit worthy, which could not be the case, by nature. Credit worthiness is fluctuating, and we need to monitor it and see how much risk we continue to take. Another thing, what should we do about this? Because the worst scenario is to simply cancel credit to a customer, or cancel credit to every customer whose credit worthiness has been deteriorated. No, this should not be like this, because we are in commercial situation. And we've got relationship with customer. We cannot simply cut them. Unless we are extremely competitive. You see, so we need to, when we look forward, when we understand what is the potential change to the credit worthiness, to the credit demand, we can sit with the customer, we can negotiate what could be done, what steps they can take from their side, what steps we can take on our side, and then how can we maintain relations, how we can maintain trade, and how we can continue to how can we continue to to cooperate for the mutual benefit, continue to cooperate. Technically speaking, we've got 3 possible decisions. In that case, so when our current terms do not work, we got 3 possible decisions. We are able to insist. It's one of the choices. We like it or not, we can simply say, okay, this is not our problem. If the credit limit is not enough, pay us earlier payment, or pay us whatever the amount which is above credit limit. And if customer agrees, this could be the plan. We may understand that this might not work in a competitive environment, so we might need to change our terms to other, but again we need to understand what terms we can offer, what terms we cannot offer to a customer, and what would be agreed by customer, what would be accepted by customer. So it's always a dialogue which needs to be facilitated with the data, with a common understanding. And the third possibility, the third option, is to make an exception. However, with exception you need to be careful, because the biggest problem with exceptions is that they got a tendency to become rules without your awareness. So like, you do one exception, then after 2 weeks customer comes for another exception, and then for another exception, and then this becomes a rule. No, this should not be like this, because each time when we give exception, we need to restrict that exception in terms of amount, meaning sum of money, and in terms of its validity. So it means that, for instance, if we increase customer temporary credit limit by 20%, this means that we give customer this temporary exception of, let's say, if assuming that, for example, their credit limit is $1 million, so we give them another 200,000, and this new credit limit is to be valid till, I don't know, November 1st, if we are today. And this, which supposed to be explained to a customer that on November 1st we are going down to usual credit limit, or we are getting back to the normal cooperation, or we sit together and discuss what is the situation at that time, because the situation could change. This way, using these three options, we are able to maintain optimal credit terms with customer in changes, in changing situation on the market, and following the changing needs of a business. Surprisingly, I did that in a quite short time. So most part of material I have explained. If you have questions, please feel free to type them in the chat or unmute yourself and ask. The floor is yours. It looks like everything is either crystal clear or completely unclear, so I need to start today's presentation again. Will somebody save me?
Hi, it's Tracy here. Sorry, I have unfortunately missed half of your presentation due to a phone call. But I think that what the big thing that I think that shows across most things is that it is about how you onboard a client from day one, what their requirements are, and how you as a business should facilitate it. And I think that you need to take a lot of different angles in deciding what kind of credit limit to give somebody, what kind of leeways you're prepared as a business to give. And I think it's having also the knowledge of what your capability as a business to extend credit limits.
Absolutely.
So it's not just one thing And I do a lot with implementing credit management processes in businesses. And we say that you have several tools to make decisions, but also it's how you've communicated in the past with that customer, what your viewpoint and your personal opinion and your expertise have been in credit management for a number of years, whether or not that gives you butterflies, or there's some stomach churning incident that decides, well, actually, I don't really trust these people, and you need to take that into account. But also it's about, you know, I've worked in businesses where they say this company is brilliant and excellent, and yes, their accounts were okay-ish, their credit limits were okay-ish, and you could have stretched it, but the reality was that what their website showed on the World Wide Web was not actually what their office looked like. In fact, it was two guys on a pasting table, hired cars, that kind of thing. So there is so many different aspects. And also when you're looking at exporting and importing, there's a whole different other level of credit management. And it is such a quite a complex role and job to have in a company to make all these decisions, that, you know, if we can utilize the information that's out there in the ether, but also collate your own data and have your own opinions and your own strategy, especially with the sales department, because there's the guys that want to get those orders over the line so they get their nice chunky bonuses, but you're the one that's got to get that debt paid. And it's interesting for me to see that obviously on this forum we've got people from all over the place.
Yes.
And obviously the way other countries do and deal with trade credit and how they pay their clients is different from other nations. So there's a huge multiple of things that you need to have a look into.
Yes. Well, it's a bit.
I know it's quite fast.
No, it's okay. No, first of all, I appreciate that you are that kind to me, not speaking that you know that fast, because I understand English is not my mother tongue, unfortunately. You see, well, as one of my favorite classics of credit management says, Declan Flood, I think you know him, he says that credit management is not rocket science, it's much more complicated.
Yeah.
You are absolutely correct. I tried to simplify this methodology as much as it is possible. First of all, to facilitate credit management communication with other functions. I find that, you know, it is quite difficult for us to you know, to not even to convince, just to make clear why we propose this or that option to decide. Like with creditworthiness, you see, we may calculate, this calculation could be precise, we may dispute one time or 1,000 times, but like if we say, I mean, the situation with 5% default probability, that was my discussion between CFO, head of sales, and myself. And I had that luxury to say, okay, we cannot grant this credit because 5% default probability is too high. You know the answer of a sales director? He told me, Andrei, with all due respect, 95% probability that customer will pay is enough to me. How can I say he is wrong? 95, okay, we use probability, yeah?
Yeah, but what's he going to do when the 5% of that comes true and he's paid his sales guys the bonus for the sale? Well, and that and the business has lost a lot of money and he can't be paid.
The thing is, in the end of the day, we have to decide.
Exactly.
We have to decide, because we cannot stand between shipping and not shipping forever. Sooner or later, we need to either ship or don't ship. You see, the creditworthiness, if you find time to look at it, is quite complicated thing, because we need to take into account owners. We need to take into account, chances that this counterpart could be fraudster. Yes, we need to take into account country risk, and we need to somehow combine together country risk and customer risk. Obviously, calculation of credit worthiness, either it ends up with default probability or credit worthiness in money, or whatever result we have is quite complicated. But we cannot come to our management, to our sales, to credit committee with all of that data.
No.
All of these numbers and say, and because in the end of the day, somebody will start to remind us the famous saying of Albert Einstein. If you cannot explain that in simple way, you don't understand that good enough. Sorry for using that rough English. But this means that if we are unable to explain that, this means that we are not doing our job properly. This is the end. This is the result. Another story with credit demand. Again, how much credit is needed? People say, okay, let's simply take sales divided by credit term, and we got it. Okay, let's grant this credit to the customer, and next week we will have sales orders on block, because this result gives us, such an approach gives us like average credit demand. But we know that today it is needed more, tomorrow it is needed less. There is a fluctuation, because everything is what is called stochastic process. So I completely agree with your idea of complexity, but this is our role, to say that, let's say, simple. This is our role to take all these data, analyze them, and then, if I can say that, so synthesize them into the credit decision. I've seen that in many associations, is that many discussions in different environments state that, the world is full of analysts who are dividing things, but then we need to combine them and to synthesize something into either a conception or something, because in the end of the day, we need to propose a solution.
I think that the way I used to discuss it with my CEOs was, how much part of this are you able to take as a risk on the business? Because at the end of the day, it is going to impact your profits and your turnover and everything else. So, when a sales director would shout at me to say, well, why are you not letting this order go? I'd say, but this is a massive order. They've never ordered something this large in the past. Why do they want this? We've got to pay for the stock before we sell it, and then they want extra terms. They want more credit limit. Is the director or the CEO of that particular company prepared to accept the responsibility to let that go out the door, because he knows he can mitigate the loss? So, if you can deliver them with all the facts and figures, and say, at the end of the day, this is your business. It's your choice, because that's the position you have. But this is what I've given you. This is my data. This is my professional opinion. And I think a lot of credit managers don't look at things simply by what you've already got, the information you've got to hand, why somebody is ordering something, or it's going to another place that's completely different from normal delivery, for instance. It could be so many different categories. You listen down and say, are you prepared? Is the business in a position that it can facilitate such a high risk? If the answer is yes, the choice is yours. Or you can split the order. I'd split the order.
Sure.
So, okay, if they want to put their money where their mouth is, then they can have X amount and we want certain percentage, but I mean, this is, if we're talking big bucks, that's why I asked about the escrow. The money's just, the promise and things like that is there, especially on an export. But, it's about negotiating. Why do you want all of this stuff in one go? Is it because it's going on a container ship to some other country? Then fine. But if it's to go to a building site, for instance, you're not going to use, I don't know, for instance, all these steel bars in 2 weeks.
Absolutely.
So that's why it doesn't have to be complicated. It's about breaking it down and simplifying it. Why do they need it? What are they using it for? Where's it going? Is there a way to mitigate the risk by scheduling the deliveries over several weeks or, what have you, and then spreading your risk? And if they don't pay the first bit, you're not getting the second bit.
Completely agree with you. I just wanted to add, you see, that's why, by the way, we started to use this non-traditional definition of creditworthiness. Reflecting creditworthiness in money. Just adding to you, you see, very often, management who takes decision. Let's assume we have no underwriting authority in credit management, and we need to advise or provide part of advice to our management. Very often, this explanation of credit risk becomes very unclear, it becomes immaterial, becomes unclear when we say default probability percent or something or whatever. Once I've heard, it's not like I've heard, I've read it in the official request for credit, please don't laugh too loudly. The credit risk is not, there is no credit risk because customer paid last 2 invoices on time.
Can I laugh?
Yes, you can. Yeah, I mean, this was a request. It's not for 1,000 credit. That was for good couple of $1 million. And customer paid last 2 invoices on time. That's understanding of credit risk. The same story as understanding about, but customer used to pay. Oh, please let's not touch this topic of, credit history and credit risk. And relationships between the two. To me, this is too obvious, and I think I said that in the creditworthiness masterclass. But why we started to do that? Because, you see, it is quite easy in this case, or using this as an instrument, it is quite easy to explain to the top management and to everyone this simple concept that in order to achieve this sale, we need $1 million credit limit, or we need to provide customer with $1 million credit. Then customer's creditworthiness is 100,000. Are we ready to put under risk, or are we ready to accept the exposure of 900,000? This could be the case. For instance, we are making extreme profit, or this is important project, or we got like market entry, whatever, but we compare all these benefits we got against this risk with already material risk. So it's not like something, or customer might not pay, or they will pay, but we are sure will they pay. No, we put under risk 900,000. Are we ready to risk them?
Exactly.
So you see, if we move a bit from all this, you see, from all these risk ideas, and try to, just step out and see what is the difference between risk assessment and decision, because these are principally two different things. Credit analyst does extremely good job, because this job is to assess creditworthiness of a counterpart and make sure, for instance, if we say in banking system, that this default probability is an agreed measures. But this is statistical or probabilistic exercise, which says that how many customers will go bust out of 100. Model could do that, credit analyst could do that, and credit analyst and the model could do that, but they can only say how many customers will go bust out of this 100 or 1000 population. Yeah, and then somebody should bet. Using these statistics, somebody should bet that on this specific customer, that this customer will either pay or won't pay.
Yep.
Because the principal difference between credit analysis and credit decision is here. Like when we come to casino, we know that, that red and white could be, 50-50 with some percentage for zero, but then we have to put our money on the table and get the result. And this is a decision. And then that's why I say, you see, in Russian, we've got one word for decision and for the solution. But to me, when we say decision making about credit is not really a decision. Okay, principal decision, we work with customer. We work with customer, we don't work with customer. But then it becomes a question on what terms we could work with this customer, because in majority cases, we are in competitive environment. To get cash, we need to sell. And we need to provide credit. So which means that we need to find a way and find terms on which we are able to work with customer. And I'm really grateful to you for mentioning that when you say this everything complicated, because to find really optimal solution, we need to know all possible ranges.
Oh, definitely. And to be quite honest with you, the one thing that I do believe, and I'd be very interested actually if the rest of you guys on this seminar will put your thoughts down, is that in every company I've ever worked with, sales just see it as selling, whereas we're looking at it as a cash perspective, and that to them it's easy, just get it out the door on a lorry or get it done or what have you. And I think that the lack of knowledge, which is something that I know that you've been putting on your polls over recent weeks on LinkedIn, lack of knowledge of what credit management's role within a whole company actually is. I think if people understood what the basis of credit management is, they would have more understanding when they're potentially negotiating or extracting the information as to why they want to increase their credit limit exponentially for whatever reason, and are there other ways around it, like can we spread things across months, etc. Most sales directors and sales people are geared to sell in bulk if they can get it all out of the door. That's great, they've hit their sales targets. And using trade credit insurance, I've seen that there's a question on here, is yes, I would use trade credit insurance, but you've also got to look at the fact that if they're not going to be insurable, you, as a business, is the business, and that's the CEO, the FD, yourselves, are you prepared to take that risk? But I think it is also down to the lack of education in businesses as to the understanding of what credit management is about. It is not about just chasing the invoices. It's about securing the trade of the company you work for?
Well, I would say that I think this is the biggest problem, and you say when lack of knowledge, or let's say too casual understanding of credit management, because for everybody it's just two lines in the balance sheet. And this, what I called in one of my posts, no money, no honey credit policy, just like, okay, credit management is not a collection, and credit management is not only chasing overdue or whatever it is, or just like I was kidding about myself. I was saying that where's our money man? No, it's not about that. We facilitate sales, and we need to educate our colleagues. And quite interesting when I've shown a couple of times this potential exposure to my sales colleagues. I said, okay, how much money we earn on this transaction to put under risk $1 million. Sometimes they say, oh, please, we are not ready for that. Okay, let's ask them for the bank guarantee. Another situation, my boss came to me and said, we would need to increase this credit limit for, to $10 million. So what is the risk? I said, whatever money we put there is under risk. So just be prepared that we may lose this $10 million every single moment of time. And then you take a decision, but the risk is like this, and it's supposed to be objective. We got a question, what do you think about using trade credit insurance coverage to mitigate the risk of on those cases? Absolutely. If we can, if credit insurance is available, we just take it as one of the options. If there are other options, we may use them as well. For instance, there is bank guarantee, there are letters of credit, standby letters of credit, other options. Credit insurance, again, if we take, I won't be getting back to my situation, but let's back to the example we were using with Tracy recently. Like, we've got $1 million credit demand or requested facility, and then we've got 100,000. Then we may go for credit insurance who say, okay, we are ready to cover this customer with a limit of $1 million. Wow, this is exactly what we are needed. This is exactly what we need. So we just take this insurance. In case of credit insurance, we don't need to involve customers. So we just transfer our risk to a third party at a fee. And this is good solution, especially if we got quite marginal business. So this cost of credit insurance will not eat too much of our profit. This could be the good solution. But before we go to credit insurance, we need to know what is the credit risk. And then we combine. You see, there are only three credit terms: credit limit, credit term, or let's say deferred credit term, and then security requirement, whether or not to ask and what type of security is available. And then combining these three things, we find optimal setup for the customer, which is supposed to work silently. For instance, in case of customers, customer goes to financial distress, let's not say insolvency. Financial distress, which means that we are covered. And the same story, for instance, again with credit insurance. We might be okay with customer setup. Another use, Morini. For instance, we were working with the customer. We used to work with the customer. We are happy with their credit setup, saying that their creditworthiness is $1 million, their credit limit is $1 million, everything's okay. But then we see that the credit demand is dramatically growing. Okay, they are, whatever reason, 1, 2, 3, 4, 5 market reason, but they need more our goods. Then we see that we used not to take credit risk, and now we have to. And if we are not prepared to that, what can we do? We can ask for credit insurance or ask them for the bank guarantee. this is like, well, like Lego. We just combine all these details and find optimal setup for every situation, because this is our job, as I think, of credit managers to, is not like choose which customer our company will work with. No. Our job is to be creative, is to be facilitative and find optimal setup for nearly every customer. As even knowing that there will be customers, there will be structures, there will be deals where it is impossible. But in that case, okay, we can simply say no. We can offer this setup, and then management will decide that okay, we will take this risk. We are not top managers. We need to understand our roles. Our role. We inform we inform our management about risk associated with the transaction. And then we let them to take a decision. Just like this. We are only employees within the company. Even being consultant, we can only advise, but being consultant, I can tell you, first thing I've learned being consultant is that I never even discuss the decision taken by my customer. So I did my best to provide them with as many possible options as possible, and then this is their choice what to choose. They chosen what they wanted, and my job is to step out and leave them with consequences. Sometimes like this. When you are internal credit manager, you have to live with this choice and you are not that free. In the end of the day, if management did a mistake, you will have to collect anyway. That's already a bit different story, but on the stage of decision making, it is like this. Okay. I do thank you very much, Tracy. Thank you very much for being with me so active and for your contribution. Ladies and gentlemen, if you still have questions or these questions will rise later on, you can find me on LinkedIn and our pages on credit engineering. You can type your questions there and I promise I will answer them. And for today and till the next hour event, I wish every one of you higher sales, lower losses, or zero losses if you prefer, or what we could say in French, bon crédit.